Hello, today is Wednesday, April 22nd, and this time we're going to make our review intro week. So it could be even more useful this time. And it's gonna be rather brief today. So the first thing that is visible right now is Bitcoin is finally getting some traction. And right now we have roughly 3 hours till the end of the trading session, and the volume is good for today. But the problem is that if you take a look, there are two problems with this supposed relief rally. So the first one, let's take a look at the hourly. So here, by the way, you can see my previous attempt to get in. It happened on, I think it was 17th of April. It was past Friday. So here was the moment when I got in, and here was the moment when I got out. Here, when it started to sink down here. So that's basically the problem with this behavior, because when you switch to the daily, it's okay. Like, you're seeing this upwards motion, and it will probably at some point will try to get closer to this 20-day moving average. Maybe people give it like 3 to 5% overall, starting with today's level of 78,400 roughly. But it's difficult to get in a conventional way. So it's still a so-called choppy market. It's still chopping around, and you are not instantly in the green when you pick up situations like this. And this was a decent looking potential breakout, way more orderly than this pullback that actually got wider here. So this case is actually good for me to teach myself to operate in the choppy environment. And chop differentiates from trend in such a way that during choppy markets you have to do the opposite of what you're supposed to do in trending markets. In trending markets, you sell weakness and you buy strength. Strength to strength, weakness to weakness. Selling weakness, buying strength. And in a choppy markets and in a consolidation, you can and you should actually be buying weakness and selling strength, buying weakness, selling strength, buying weakness, selling strength, and so on. And with the choppy market that has upwards bias, you are still supposed to buy weakness, but maybe on a lower time frame. Maybe you could use Fibonacci or some additional tools for that to try and pick the moment when the support will finally be found, maybe buy it off a moving average. And then you could even position yourself for a short-term trade, like for a day or two or three, or even for a larger move, which will be choppy, but will still have a directional bias. So here's the lesson of what's happening now. And the other peculiarity of this situation is that while it is chopping around, this long-term moving average is playing catch-up here. And in my personal view, this convergence of this structure here and this moving average here will put additional pressure on this relief rally, and also it's quite short for Bitcoin. Obviously, Bitcoin is less volatile. For Ethereum, the situation is roughly the same, but the numbers percentage wise are a bit better. It's 10 to 15% till some interference from this structure will be noticeable in the price. Obviously, another consideration that you have to keep in mind right now is that it is a heavily news-driven market, and everything could happen. For example, if Iran and the States all of a sudden come to the final, the most final of them all, like the conclusion of the war, and all of a sudden they're friends now, and obviously the market will wait maybe for a bit, because what I'm seeing now is that the market is learning to discount political statements. And if the market will wait and see that it's for real, then it could just burst through this downtrend line and off to the races, maybe to this previous highs, in a manner that's a bit similar to what we're seeing in the stock market. So before we switch, apart from that, there is not much to report. Everything is more or less correlated at the moment, and nothing I find particularly interesting here. What's interesting to point out is that yes, it's volatile, but at the same time, Bitcoin dominance is growing. So the how do you say it, like the biggest and the most important coin is taking the lead here. And another thing is that we are seeing these retests in USDT dominance, and obviously it looks quite a bit like this chart, the chart of Bitcoin, but inverted, and it's basically tells the same story, but at the same time it's noticeable because it is not only Bitcoin. If we'll see a definitive break of USDT dominance, that will mean that Bitcoin obviously will continue its movement, but there will be a movement in other more volatile coins here as well. The rest of the universe, so to speak, the new finance. Okay, so today I actually want to focus on secondary outcomes of the oil crisis that took place with this war. As you can see now, oil found some support of the 50-day moving average, and it tries to climb back a bit, and I wouldn't completely rule out other spikes and maybe even a test of previous highs here at 120, 130. But in my opinion, in my assessment, this time we are very, it's like the last hooray for oil at large, because I did a short video the other day in which I pointed everything out, but I will try to repeat myself really quick now. So I think the 70s are the example of what's happening and what we will see with oil quite soon. So what happened in the 70s? First, we got an attack on Israel by Egypt and Syria, and Western countries supported Israel, and in return, Arab states closed the valve, and they basically embargoed oil supplies to the West, and that caused the recession. That was the first oil crisis of the 70s. And the second oil crisis happened when Iran actually had a revolution that created the modern religious government, which Donald Trump is fighting with or negotiating with right now. We don't exactly know what's happening there. And that caused another spike in the price of oil and the recession afterwards. But the fact that the exponential growth of the oil price in the 70s that brought it from $2.5 to $30 to $40 at the end of the decade was concluded by decades long of price decrease is a good historical lessons, because there are two things at play there. So first, by definition, high oil prices lead to lower oil prices because they make production more expensive, and you can consider it like an additional tax on production or additional taxation of the economy overall, because transportation, which is 50% of oil consumption, is everywhere. You just cannot avoid it these days, even with the new technologies that are present right now, but we will talk about it a bit later. So by definition, high oil prices lead to lower economic activity, and that in turn leads to lower oil prices for longer. And on top of that, new oil producers stepped in, and it was not United Kingdom, but British Commonwealth, Mexico, and the States. And new logistics routes were created, and the world adopted. And that led to the decline of the price, maybe to $8 in 1998, and it was triggered by the financial crisis in Asia. So right now we are in exactly the same situation, but what's different this time is that the market is much more flexible these days, and you don't have to wait for the states to enter the market. They are already there. New oil exporters like Guyana are already there too, and on top of that, the major consumers, the states, they consume roughly 20% of the oil supply, and China, who consumes roughly 15% of the oil supply, and with India, that has another 5%, and totally they account for 40% of total oil consumption. All of them, well, primarily states and especially China, India will just follow the trend, are switching to electric vehicles. And not only personal vehicles, but also business vehicles. And China, as I've said, is clearly leading, and they have already put into place very big initiatives that will make them structurally independent from oil till 2015 is here. So that basically means that the largest consumers in this market are flattening their demand increase. And that is a big additional factor which will suppress the price of oil. So the conclusion here is that this spike will be rather short-lived. Even if the war drags on, it will not take decades for the price to be suppressed again. My estimation is that it's like months or maybe a few years at best, and then the market catches up and the technology will see drastic increase in investment. And in that regard, I could share some ideas here. So the first one and the most recent one here is copper. And copper is an absolutely necessary part of every electric infrastructure, be it wiring, transformers, and all the parts of electro infrastructure and the vehicles themselves, of course. So that's why it looks so good, and it has already seen this uptrend, and it's quite volatile, obviously, but all commodities are. But the overall trend is up, and I think it starts to price in this drastic increase of investment in that domain, in alternative energy, and also in AI, because copper is widely used in everything that concerns high tech, so to speak. So that's why it looks so nice, and there are definite signs of institutional positioning here. Obviously, the next stop is this level, and we'll see how it goes, or maybe something here. There are clearly sellers here, so we'll see how the situation develops. What else? The other type of the company that is about to emerge is a full cycle alternative energy company that designs alternative energy, solar energy plants, and deploys them. Not like this, like bringing the end product to the market, so to speak. Integrated solution for the new economy that will be exploding with orders to deploy, to create, and to deploy non-oil energy sources. And other participants here, honorable mentions, are nuclear reactors, but these guys, they were the front runners. They started pricing it in thanks to the AI craze in the second half of 2025. So these names will be probably the headliners of the next cycle once the market stabilizes. And when it comes to the broader market, it's a difficult situation to analyze. The first thing to admit here is that that V-shaped recoveries are becoming quite often, and they're not abnormal situation these days. So that's the thing to keep in mind. And the second thing to keep in mind is that such V-shaped recoveries are actually quite bullish, and they create an impulse for the rally. And as you can see, it's flagging now, very short flag, and MNQ or NQ or QQQ Nasdaq is actually already breaking out from that short consolidation. So that tells you something as well. But the problem with this market is a lack of setups. So not many well-defined setups, and but it's there to work, and money should be deployed to the market, and some things are definitely actionable here. Few of them I've mentioned, and you just have to go with the flow. Like, if the ocean is okay to surf, you gotta surf. So let's keep this in mind. But at the same time, you gotta remind yourself that if all of a sudden the weather changes, and it is possible in such an environment, and the environment is very choppy, is very volatile, and it's news driven. And the news are not macroeconomic news. Macroeconomic news you can just try to predict in economic calendar, and it doesn't load for some reason, but you could just go to the one that loads and plan ahead. But when there is no plan, and the plan is just when politicians wake up and when they decide to make statements, you cannot plan for this in advance. Even if you study the schedule of the President of the United States, well, Ayatollah doesn't have a publicly available schedule, or whoever is issuing statements from the Iranian side at the moment. So you got to be prepared for that, and preparation obviously means risk management, strict, predefined risk management, and discipline in executing this risk management that you have imposed on your trades. Well, I guess that's it for today. Take care. Bye.